Welcome to Aehr Financial. Today, we are putting Aehr Test Systems, that's ticker symbol AEHR, through the absolute ultimate fundamental stress test. We are tearing down their fiscal 2026 fourth quarter and full year results, and we are analyzing the raw data behind what is, frankly, one of the most aggressive growth forecasts we've seen in the semiconductor equipment space in a long time. I am your lead analyst, and as always, I am intensely focused on the structural integrity of the numbers. We're talking cash flow, backlog composition, operating margins, and the underlying unit economics.
And I am the market skeptic. My job here is to find the stress fractures. We're going to find out if this company is actually forging a load-bearing foundation for real long-term growth, or if retail investors are walking blindly into a massively overhyped cyclical trap. Because let's face it, we see that all the time. If you want to forge a stronger portfolio and cut through Wall Street's noise, hit that subscribe button. All right, let's get right into the heavy lifting.
Okay, let's start by dropping the anvil right on the table. Aehr Test Systems just guided their fiscal 2027 revenue to land somewhere between $130 million and $150 million. To give you the mechanical context of why that's so shocking, their fiscal 2026 revenue was exactly $50 million. We're talking about a massive 160 to 200% top-line explosion year over year. Going from 50 to 150 in a hardware business, that requires a complete rewiring of their production capacity. It requires absolute flawless execution.
It is a jaw-dropping headline, there's no doubt about it. But look, when management suddenly forecasts a triple-digit growth rate in the hardware space, my immediate reaction is to grab the clipboard and check the structural limits. Semiconductor equipment is notoriously boom and bust. So the question we have to ask is this target legitimate? Or is it just the latest company bolting the letters A and I to their press release to juice the stock before reality sets in? Because we've seen that movie before.
And that brings us directly to the central debate of this explainer. The primary driving force behind this $130 million to $150 million target is a massive, fundamental shift in how AI processors and hyperscale data center chips are actually being tested. Aehr's claiming they're at a legitimate inflection point right now, transitioning out of smaller niche markets and moving into the absolute core of global AI infrastructure.
Right, but an inflection point has to be built on solid bedrock, not just a few massive purchase orders from a highly concentrated customer base. We need to figure out if this AI burn-in demand is a permanent architectural shift in semiconductor manufacturing, or if this is just cyclical hype that is absolutely going to crack under the pressure of actual delivery schedules. A forecast is just a piece of paper until the machines actually ship.
Exactly. So here is our inspection protocol for today's explainer. Number 1, forging the headline. 2, foundation, balance sheet dilution. 3, drill down, earnings slump. 4, catalysts and structural cracks. And finally, number 5 will give you the Aehr financial verdict. Section 1, forging the headline. Now, I want you to listen closely to CEO Gayn Erickson's exact wording on this quote. He states that record quarterly bookings and effective backlog provide substantial visibility into that $130 to $150 million number. The reason this matters is that this isn't just a speculative forecast based on some broad, theoretical total addressable market. They are just guessing. This represents a 2.6x to 3.0x leap over their previous year, heavily anchored by actual purchase orders that are already sitting in their system waiting for fulfillment.
Right. They aren't just projecting demand into the ether. I'll give them that. But the word visibility is a notoriously loaded term on Wall Street earnings calls. A backlog is literally only as good as a company's ability to actually manufacture, assemble, and deliver that hardware on time, without massive supply chain bottlenecks getting in the way. To scale industrial production by roughly 200% in a single fiscal year requires immense capital and absolutely flawless logistics. You can't forge that much steel without burning a lot of coal, right? Which leads us exactly to how they are paying for this massive acceleration.
Section 2, foundation, balance sheet dilution. Check out this year-over-year comparison. This is fascinating. In fiscal 2025, Aehr had $24.5 million in cash and cash equivalents. Pretty standard. But by the end of fiscal 2026, they had fortified that cash pile to a staggering $116.5 million. The velocity of that accumulation is what really stands out here. Because even just 1 quarter ago, in Q3 of FY26, they only had $37.1 million. So they have essentially built an absolute war chest with zero long-term funded debt to support the massive production scaling required for their Fox XP and Sonoma systems.
Okay, hold on. Let's pump the brakes right there. Yes, a fortress balance sheet looks fantastic on paper, but cash doesn't just magically appear out of thin air, especially when your core operations aren't the thing funding it. You have to look at the mechanic behind how that massive cash cushion was built. It wasn't built purely from the operational engine, because they actually burned $3.3 million in operating cash this year. So, where did it come from?
It came from $97.4 million in net proceeds raised via public equity offerings. That cash was raised at the direct expense of shareholder equity. They heavily utilized an at-the-market or ATM program, actively selling off shares to the public. If you dig into the SEC filings, their outstanding common shares went from 29.8 million in FY25 up to 32.4 million by the end of FY26. That is nearly a 9% dilution to existing shareholders in a very, very short window. So yes, sure, they have the capital to build the machines now, but retail investors just paid a very heavy toll for that structural integrity.
Look, that is a perfectly fair critique of the capital structure. Dilution is always the friction cost of rapid industrial scaling. But frankly, as an analyst, I would much rather see a management team proactively raise capital while the broader market is incredibly thirsty for AI infrastructure plays. This ensures they don't face a catastrophic liquidity crunch right when they need to rapidly double their manufacturing footprint and secure all those long lead time components. Sometimes you have to reinforce the concrete before you build the skyscraper.
Section 3. Drill down the earnings slump.
Let's look at the full-year slump first, because it's glaring. Fiscal 2026 net revenue declined to $50.0 million from $59.0 million the year prior. That is a clear structural contraction, and it highlights a major vulnerability for this company. Electric vehicle demand for Silicon Carbide, which, let's remember, was their absolute darling growth market just a year ago, slowed down industry-wide. Customers pushed out orders left and right. So for the first 3 quarters of the year, this company was basically bleeding momentum and watching their legacy growth engines stall out completely. Okay, true, but then Q4 hit like a sledgehammer. Q4 revenue spiked to $18.8 million, up from $14.1 million year over year. Almost 38% of their entire annual revenue was recognized in just the last 90 days of the fiscal year. They shifted production into absolute overdrive to meet an immediate surge in demand for their wafer-level and package-level burn-in solutions. They pivoted hard from silicon carbide EVs right into AI processors, and they executed that pivot in real time. And to really understand the unit economics here, you have to peel back the accounting layers of their profitability. On a generally accepted accounting principles or GAAP basis, Aehr posted a net loss of $7.1 million for the year. But if you look at the non-GAAP reconciliations, they actually eked out a net income of $0.9 million. Come on, how exactly are we bridging a $7 million loss to a supposed structural profit? You can't just ignore real expenses because they don't look pretty. We do it by stripping out the non-cash and one-time friction costs that do not reflect the core operational cash generation of the business. We are adding back $6.8 million in stock-based compensation. We are also adding back roughly $864,000 in restructuring charges, which were specifically related to the early lease termination and closing of their Inca facility in Fremont so they could consolidate their manufacturing footprint. Closing a factory isn't free. When you clear out that accounting noise, the core operational engine actually maintained basic profitability during a down revenue year. And in Q4 alone, they posted a non-GAAP net income of $3.6 million or 11 cents a share. But honestly, this is the trump card right here. This is the structural steel supporting that massive $130 to $150 million guidance. As of May 29th, they reported a backlog of $80.6 million. But when you include the bookings received shortly after the quarter closed, their effective backlog is a staggering $100.6 million. They booked a record $60.7 million in just the fourth quarter alone. Let that sink in. Okay, I will admit, $100.6 million in effective backlog is undeniably a massive number for a company that just did $50 million in annual sales. It's huge. But remember, a backlog is just a promise to pay. It isn't revenue until the machine is actually built, shipped, installed, and signed off by the customer. We need to expose this foundation to some environmental stress and look at the actual real-world risks of conversion.
Section 4. Catalysts and structural cracks.
Let's break down the growth engines, starting with the absolute heaviest lifter, AI accelerators and wafer-level burn-in, or WLBI. Historically, semiconductor chips are tested after they are packaged. But AI chips are incredibly complex, right? They are stocking multiple accelerators alongside high-bandwidth memory, or HBM. If an early failure occurs at the package level, the manufacturer has to scrap the entire expensive memory stack and substrate. The cost of the substrate alone can be more than a single processor. It's an expensive mistake. Aehr's Fox XP systems allow customers to burn in and test at the wafer level before packaging. The yield savings absolutely dwarf the cost of the test. It's a game changer.
And they are also seeing traction with their Sonoma systems for package-level burn-in, correct?
Exactly. Their new higher power Sonoma systems can support up to 2,000 watts per device to stress test these massive next-gen hyperscale data center chips. Outside of AI, they are also seeing a recovery in Silicon Photonics for optical data center I/O, and they are continuing to develop capabilities for heavy-duty gallium nitride power semiconductors operating at 600 volts. Okay, all of those growth pillars sound fantastic on an earnings call. But here are the structural cracks in the armor. First, customer concentration risk. While they are expanding into AI, a massive chunk of this $100 million backlog is heavily reliant on a very small handful of hyperscaler and test lab customers. If one of those Tier 1 customers decides to push out a delivery date by just 3 months, that $150 million revenue target instantly collapses.
That is a very valid concern. Silicon carbide demand for EVs already pushed out on them this past year, perfectly illustrating how vulnerable they are to single industry cyclicality.
Exactly. We just saw it happen. Second is the execution lead time risk. Management is targeting 18% to 22% non-GAAP net margins on that $130 to $150 million revenue. To hit those margins while simultaneously scaling production by 200%, integrating a newly consolidated manufacturing facility, and delivering highly customized wafer packs without running into supply chain bottlenecks, that requires absolute flawless execution. There's zero room for error built into this valuation. If margins compress during the massive scale-up, the bottom line suffers severely, even if they somehow miraculously hit the revenue target. Section 5. The Aehr Financial Verdict. All right, I'll go first. For me, Aehr Test Systems is a reinforced steel buy. Yes, the recent dilution definitely stings existing shareholders, no argument there. But management utilized the public equity markets exactly how growth companies should, to build an impenetrable $116.5 million balance sheet that completely de-risks their aggressive expansion plans. The shift to wafer-level burn-in for AI processors isn't just some passing fad, it is a fundamental architectural necessity to prevent catastrophic yield losses on $40,000 AI chip modules. The $100.6 million effective backlog proves the industrial demand is very, very real. If you can stomach the volatility, the foundation here is structurally solid. I totally respect the engineering argument, but I am rating this a high-risk speculative hammer. Look, the market is currently pricing in absolute perfection from this management team. They just diluted shareholders by 9% to build that cash pile, and their recent track record with the Silicon Carbide slowdown proves that customer orders can evaporate or get delayed at the drop of a hat. Scaling from $50 million to $150 million in just 12 months, while desperately trying to hit 20% net margins, is a logistical nightmare waiting to happen. If they miss a single quarterly delivery target or face one single component shortage, Wall Street will absolutely shatter the stock. It's simply too much customer concentration risk for my capital. And, that is the beauty of the market. You have two analysts looking at the exact same financial blueprint and seeing two entirely different structures. Whether you see a reinforced foundation or a cyclical trap, the raw numbers don't lie, only the interpretations do.
That's exactly right. You have to do your own heavy lifting, you've got to dig into the SEC filings, and absolutely never take management's word at face value. Protect your capital, know your structural limits, and keep stress testing the hype. Thanks for joining us at Aehr Financial, and we will see you on the next explainer.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.